Dive into the market. Your path to riches awaits. The stock market is a thrilling roller coaster of potential profits, where fortunes can be made and lost in the blink of an eye. Imagine the excitement of watching your investments grow, the adrenaline rush of making quick decisions, and the satisfaction of seeing your strategies pay off. The stock market offers all this and more. But it's not just about luck. It's a game of skill, strategy, and a little bit of luck. Successful traders spend countless hours analyzing data, studying market trends, and honing their strategies. They understand that every decision carries risk, and they are prepared to navigate the ups and downs of the market. It's a dynamic environment where quick thinking and adaptability are key. Two popular approaches to navigating this exciting world are day trading and swing trading. Day trading involves buying and selling stocks within the same day, capitalizing on short-term market movements. Swing trading, on the other hand, involves holding stocks for several days or even weeks, aiming to profit from longer-term trends. Both offer the potential for significant returns, but they require different mindsets, strategies, and levels of commitment. So, buckle up and get ready to explore these two exciting trading styles. Understanding the differences between day trading and swing trading is crucial for any aspiring investor. It's like choosing between a speedboat and a yacht. Day trading is fast-paced and requires constant attention, while swing trading allows for a more relaxed approach with less frequent trades. Each has its own advantages and is suited for different types of journeys. Day trading can offer quick profits, but it also comes with higher risks and requires a significant time commitment. Swing trading, on the other hand, can provide more stable returns and is often less stressful, but it requires patience and a longer-term perspective. Whether you're seeking quick profits or aiming for long-term gains, choosing the right strategy is paramount to your success. Educating yourself about these strategies, understanding the market, and continuously learning are essential steps on your path to riches. There are countless resources available, from books and online courses to seminars and mentorship programs. Practice is also crucial. Many successful traders start with demo accounts to hone their skills without risking real money. This allows them to test their strategies, learn from their mistakes, and build confidence. Joining a community of traders can also be incredibly beneficial. Sharing insights, discussing strategies, and learning from others' experiences can provide valuable perspectives and support. Setting clear financial goals and developing a well-thought-out investment plan are key components of successful trading. Knowing what you want to achieve and having a roadmap to get there will keep you focused and motivated. Remember, the path to riches is not a sprint, but a marathon. It requires dedication, perseverance, and a willingness to learn and adapt. But with the right mindset and strategies, your path to financial success is within reach. So, what are you waiting for? Start your journey today and take the first step towards achieving your financial dreams. Your path to riches awaits. Day trading. Catching the quick wave for fast profits. Day trading is the adrenaline junkie's approach to the stock market. It's a fast-paced, high-stakes game where every second counts, and the rewards can be substantial if you play your cards right. It's all about speed, precision, and capitalizing on short-term price fluctuations. The goal is to make quick decisions and execute trades with impeccable timing. Imagine yourself as a surfer, riding the waves of market volatility. Just like surfing, day trading requires skill, practice, and the ability to read the waves, or in this case, the market trends. You need to be quick, decisive, and ready to jump off when the wave starts to crest. This means having a solid exit strategy and knowing when to cut your losses or take your profits. Day traders typically execute multiple trades within a single day, aiming to profit from small price movements. This can involve buying and selling the same stock several times in a day, or trading different stocks based on market conditions. They utilize technical analysis tools like moving average crossover and the relative strength index, or RSI, to identify potential entry and exit points. These tools help traders make informed decisions by analyzing past price movements and predicting future trends. For instance, a day trader might buy Reliance Industries shares when its 50-day moving average crosses above its 200-day moving average, signaling potential upward momentum. This crossover is often seen as a bullish signal, indicating that the stock price may continue to rise. They might then sell the shares later in the day when the RSI indicates the stock is overbought. The RSI, or Relative Strength Index, measures the speed and change of price movements, helping traders determine if a stock is overbought or oversold. Day trading is not for the faint of heart. It requires intense concentration, quick reflexes, and the ability to stay calm under pressure. The market can be unpredictable, and even the most experienced traders can face losses. Successful day traders often keep detailed trading journals, recording their trades, strategies, and outcomes. This helps them learn from their mistakes and refine their techniques over time. Many day traders also join trading communities or forums to share insights, discuss strategies, and stay updated on market news. Networking with other traders can provide valuable support and knowledge. Despite the high intensity, it's important for day traders to take breaks and manage stress. A clear mind leads to better decision-making and ultimately more successful trades. At the end of the day trading is about riding the quick wave for fast profits. With the right skills, tools, and mindset, you can navigate the market's ups and downs and come out ahead. Swing trading. Riding the momentum to market success. Swing trading is like sailing on a steady wind. It's about identifying and capitalizing on trends that play out over several days or even weeks. Think of yourself as a captain charting a course. You study the charts, analyze the winds, and set your sails to catch the prevailing currents. Swing traders hold their positions for longer durations than day traders, aiming to profit from more significant price swings. They use a combination of technical and fundamental analysis to make informed decisions. For example, a swing trader might buy ICICI Bank shares after noticing a positive shift in market sentiment towards the banking sector. They might also analyze the bank's recent financial reports and identify positive trends in earnings and loan growth. Technical analysis, your secret weapon for spotting opportunities. Both day traders and swing traders rely heavily on technical analysis. This involves studying charts, patterns, and indicators to predict future price movements. It's like reading the tea leaves of the market, looking for clues about where prices are headed. Indicators like the Moving Average Convergence Divergence, or MACD, Bollinger Bands, and moving averages can help traders identify trends, reversals, and potential entry and exit points. For example, a trader might notice that Infosys is trading within a narrowing Bollinger Band range, suggesting a potential breakout is imminent. They might then look for a confirmation signal, such as a MACD crossover, before initiating a trade. Nifty 50 Insights, real-world examples for trading success. The Nifty 50 index is a benchmark of the Indian stock market, representing the top 50 companies listed on the National Stock Exchange. It provides a comprehensive snapshot of the market's performance and is a popular choice for traders looking to capitalize on market movements. Let's look at some real-world examples from the Nifty 50 index to illustrate how day trading and swing trading strategies can be applied. These strategies can help traders make informed decisions and potentially achieve significant returns. By understanding the nuances of these approaches, traders can better navigate the complexities of the stock market. A day trader might focus on HDFC Bank, a highly liquid stock with significant intraday price fluctuations. HDFC Bank is one of the largest private sector banks in India, known for its strong financial performance and market presence. Day traders are attracted to such stocks because of the opportunities they present for quick profits within a single trading day. They might buy shares at the market open if they notice a strong bullish candlestick pattern forming on the 5-minute chart. Candlestick patterns are a popular tool among traders for predicting short-term price movements. A bullish pattern indicates that the stock price is likely to rise, prompting traders to take a long position. They might then set a profit target based on recent resistance levels and a stop-loss order to limit potential losses. Risk management is crucial in day trading as it helps protect traders from significant losses. By setting a stop-loss order, traders can ensure that they exit a trade if the price moves against them, minimizing their risk. A swing trader, on the other hand, might focus on identifying stocks with strong underlying fundamentals, such as Reliance Industries or Tata Consultancy Services. Swing trading involves holding positions for several days or weeks, aiming to profit from medium-term price movements. Stocks with solid fundamentals are often more stable and less volatile, making them ideal candidates for swing trading. They might analyze the company's financial reports, industry trends, and overall market sentiment before initiating a position. Fundamental analysis helps traders assess the intrinsic value of a stock and determine whether it is undervalued or overvalued. By considering factors such as earnings, revenue, and industry performance, swing traders can make more informed decisions. Their goal is to capture a significant portion of an upward price move that could last for several days or weeks. Swing traders aim to take advantage of market trends and price momentum, holding their positions until they believe the trend has run its course. This approach requires patience and discipline, as traders must be willing to hold their positions through short-term fluctuations. By combining technical analysis for day trading and fundamental analysis for swing trading, traders can develop a well-rounded strategy that leverages the strengths of both approaches. Understanding the characteristics of different stocks and market conditions is key to achieving trading success. Whether you prefer the fast-paced nature of day trading or the more measured approach of swing trading, the Nifty 50 index offers a wealth of opportunities for traders to explore and capitalize on.